Cathie Wood's primary Ark Invest fund has fallen victim to a widespread sell-off in technology companies, and it appears that it may take a while for the well-liked ETF to recover. The flagship fund of New York City-based Ark Invest posted shocking losses recently as significant assets like Tesla, cryptocurrency exchange Coinbase, and virtual healthcare provider Teladoc fell amid a sell-off that has erased the high-profile fund's spectacular gains during the outbreak. Shares of the Ark Innovation ETF, which boast ownership of disruptive innovation businesses, plummeted as much as 7% on Thursday, hitting its lowest point since April 2020, despite moderate advances for the overall market. The stock leading the decline is Teladoc, the fund's third-largest holding. On Thursday, it experienced its biggest one-day decline, after reporting worse-than-expected earnings and CEO Jason Gorevic's warning that higher advertising costs and ongoing COVID uncertainty would lead to lower-than-expected revenue. As investors continue to consider the potential drawbacks of CEO Elon Musk taking a direct role in Twitter following his bid to acquire the social media giant, shares of top holding Tesla also fell, falling 4% to pare gains after a stunning plunge on Thursday wiped out approximately $128 billion in market value. The situation would be significantly worse if Tesla, Ark Innovation's largest position and relative outperformer compared to other fund components, didn't exist. Even though the electric car manufacturer has lost a significant amount of value since its high on November 4th, the decline has been much less severe than that of other stocks in Ark. For instance, Berkeley Lights, BLI, a digital biology company, is down more than 94% from its 5-year peak. Despite rising by 150% in 2020, Ark's flagship fund fell by 24% last year and another 49% this year, compared to an 11% drop for the S&P 500. Cathie Wood, CEO of Ark, has been unwaveringly bullish on the tech industry throughout this year's plunge. She told investors at a conference and said that despite the recent sell-off, technology fundamentals have not deteriorated for the most part. She later gave Tesla a 4-year price target of $4,600 per share, more than 5 times current levels. When the broader falls are considered, Tesla, which makes up around 10.4% of total holdings, has prevented the fund from dropping significantly worse. Additionally, Ark Invest keeps placing big bets on Tesla to support it and fulfilling its lofty investor promises. Ark Investment Management raised its already lofty $3,000 price objective on the manufacturer of electric vehicles earlier this week to $4,600 by 2026, citing the company's potential robo-taxi business and forecasts that it will become more capital efficient. Despite being set to their predictions for 2026, Ark analyst Tasha Keeney stated in a recent research note, they anticipate that in 2026, Tesla's stock will trade more like that of an established business than a startup. Wood often underlined that Ark's investment strategy's emphasis on a 5-year time horizon is a crucial component, even branding the typical asset manager's time horizons of 12 to 18 months as short-sighted. The company favors businesses that are frequently unprofitable and whose stock prices are closely connected, according to Morningstar strategist Robbie Greengold. The firm uses its past as a guide to the future and views risk almost exclusively through the lens of its bottom-up research into individual companies, according to the study, rather than gauge the portfolio's aggregate risk exposures and simulate their effects during various market conditions. Wood said that those who invest in Ark's funds should be responsible for risk management rather than her. It's hard to see why that should be the case, Greengold penned. Ark could have done more to prevent significant wealth losses, and its recent negligence in this area has damaged many investors. In the future, it might hurt more. So now, financial history students won't be surprised by Ark Invest's impending collapse. Supporters of Wood will point out that despite the current drop, the Ark Innovation ETF has produced average annual gains of about 40% over the previous 5 years. Definitely an incredible number. However, it has a track record of averaging yearly gains to Lynch's Magellan Fund while having a smaller asset base. These types of returns are pretty rare for investors in the real world. Wood, meanwhile, is denigrating. "We are nothing near a bubble," Wood said during a recent appearance on CNBC as she praised the potential of Tesla and Bitcoin. Investors are becoming less and less inclined to swallow that particular medication. Here's the truth. The ETFs from Ark Invest is in a risky zone because of their significant holdings in illiquid stocks. The panicked exodus of investors will destabilize them the instant someone cries fire in this jam-packed theater of Ark Invest ETFs, and more swiftly than most investors anticipate. So congrats if you were an early investment in an Ark Invest ETF. However, I advise you take your money and run away.